In 2026, something has shifted in America. Not with a crash. Not with sirens. Not with one defining headline that everyone remembers. But with a quiet, steady pressure that people feel in their daily lives. The collapse of everyday American life isn't dramatic. It's subtle. And that's what makes it dangerous. For decades, the rhythm of American life felt predictable. You went to school. You got a job. You worked hard. Maybe you struggled at first, but over time, things improved. Your parents' generation had built stability. You were supposed to build more. That expectation wasn't just economic. It was cultural. But in 2026, that momentum feels different. Not gone. Just heavier. Start with housing. Owning a home used to be the anchor of middle-class life. It represented arrival, stability, proof that you had made it. Today, for millions of Americans, it represents anxiety. Mortgage rates remain far higher than people grew accustomed to during the ultra-low era of the 2010s. Home prices never meaningfully reset in many regions. Even markets that cooled slightly never became truly affordable again. In cities once considered affordable places like suburban Arizona, parts of Florida, sections of Texas, prices surged during migration waves and never fully came back down. A dual-income household, making what used to be considered good money, now runs the math and hesitates. The down payment feels unreachable. The monthly payment feels suffocating. Property taxes and insurance keep rising. So people wait. And while they wait, rent keeps climbing. The rental market has become its own pressure chamber. Corporate landlords expanded. Supply lagged in key metros. Insurance costs filtered down to tenants. What used to be a temporary phase renting in your 20s has stretched into the mid-30s for many Americans. Roommates aren't just for college students anymore. They're for professionals. And this shift changes more than housing statistics. It delays marriage. It delays children. It reshapes family planning. It pushes milestones further into the future. Now walk into a grocery store. You don't need economic data to understand what happened over the last few years. You feel it immediately. A cart that once cost $150 now creeps toward $230 without looking dramatically different. Portions are smaller. Packaging is thinner. Store brands aren't a discount strategy, they're survival. Americans have adapted. They compare prices more. They track weekly ads. They buy in bulk when possible. They cut impulse purchases. But what's changed isn't just spending behavior. It's mental bandwidth. Every purchase now carries a calculation. Can we afford this? Is this necessary? Can we wait? That constant calculation creates quiet exhaustion. Then there's healthcare. Insurance premiums remain high. Deductibles remain high. Out-of-pocket costs remain unpredictable. Even insured families hesitate before scheduling procedures. Routine checkups get postponed. Dental visits get delayed. Prescriptions are stretched. Medical debt still shadows millions of households. In theory, coverage exists. In practice, affordability remains fragile. Now, layer on employment. Official unemployment rates may not signal crisis, but job security feels thinner than it used to. Layoffs in certain sectors never fully stabilized. White-collar workers discovered how quickly entire departments could disappear. Automation and AI integration reshaped roles faster than many expected. Even high performers feel replaceable. The idea of a career ladder feels less stable than it once did. Lateral moves replace promotions. Contract work replaces long-term guarantees. Benefits packages shrink quietly. Remote work, once a breakthrough in flexibility, has partially reversed. Hybrid mandates bring back commuting costs, gas, parking, wear and tear on vehicles, unpaid time in traffic. Each individual cost seems manageable. Together, they compress budgets. Credit card balances across the country sit near historic highs. Not because Americans suddenly lost discipline, but because expenses outpaced income growth for too long. Credit fills the gap. Buy now, pay later services expanded into everyday categories: groceries, utilities, even medical bills. Debt isn't funding luxury, it's funding normal life. Student loans resumed years ago, and many borrowers never fully restabilized. Payments compete with rent, with car insurance, with rising food costs. So people delay decisions. They delay upgrading apartments. They delay weddings. They delay starting families. They delay risk-taking. This is what a slow collapse looks like. Not abandoned buildings, not mass panic, but millions of small postponements, small compromises, small recalibrations. The American dream wasn't only about becoming wealthy. It was about forward motion, about believing that effort translated into upward movement. In 2026, many Americans still work hard. Some work harder than ever. But the distance between effort and progress feels wider. And when that gap widens long enough, something psychological shifts. People stop expecting acceleration. They aim for stability. And when stability itself feels expensive, everyday life begins to feel fragile. This isn't a collapse you see in one quarter's GDP report. It's a collapse you feel in daily routines, in receipts, in late-night budget conversations, in the quiet question couples ask each other, "Are we going to be okay?" And for the first time in decades, more Americans hesitate before answering. That hesitation is new. For generations, even during recessions, most Americans believed downturns were temporary. A rough year, a hard stretch. But eventually, things would rebound. Jobs would return. Wages would rise. Opportunity would expand. In 2026, the fear isn't collapse overnight. It's permanence. It's the possibility that this level of strain is the new baseline. Look at the middle class. For decades, it was the backbone of the country: homeowners, small business owners, skilled workers, teachers, nurses, managers. Not rich, not poor, but stable. Now the middle feels squeezed from both sides. Insurance premiums climb every year. Health, auto, home. Property taxes adjust upward, with inflated valuations. Childcare costs rival college tuition in some states. Even after-school programs, sports leagues, and extracurricular activities carry higher fees. Raising a child has always been expensive. Now it feels financially strategic. Parents calculate everything. Can we afford another child? Can one parent stay home? Does working full-time even make sense after daycare costs? These aren't luxury questions. They're structural ones. Small businesses feel it too. Higher interest rates made borrowing more expensive. Expansion plans slowed. Commercial leases remained high in many areas. Insurance costs, especially in states hit by extreme weather, spiked dramatically. Some family-owned restaurants that survived the pandemic years are now quietly closing, not because customers disappeared entirely, but because margins vanished. Food costs rose, labor costs rose, utilities rose. But customers squeeze themselves, resist higher menu prices. So owners absorb the pressure until they can't. You see it in reduced hours, smaller staffs, shorter menus. It's not dramatic failure. It's gradual contraction. Retail tells a similar story. Discount chains expand, while mid-tier brands struggle. Consumers trade down. Luxury brands still perform well, supported by higher-income households whose assets appreciated. But aspirational middle-market retailers face declining foot traffic. This creates a visible divide. Some neighborhoods thrive upscale developments, new restaurants, strong property values. Others stagnate vacant storefronts, deferred maintenance, slower growth. Inequality isn't new in America. But in 2026, it feels sharper, more visible, more personal. Then there's the psychological layer. Americans are resilient. They adapt quickly, but adaptation comes with cost. When inflation surged earlier in the decade, people adjusted spending habits. When gas prices spiked, they drove less. When groceries became expensive, they switched brands. But constant adjustment rewires expectations. People stop planning 5 years ahead. They plan month to month. Savings rates fluctuate because building long-term reserves feels harder when short-term expenses keep rising. Retirement planning has grown more uncertain. Older Americans worry whether their savings will stretch far enough in a world where healthcare costs remain unpredictable and living expenses rarely fall back to previous levels. Younger Americans question whether traditional retirement is even realistic. Side hustles, once symbols of ambition, are now normalized survival strategies. Driving for rideshare after a 9-to-5 job, selling handmade goods online, freelancing at night, tutoring on weekends. Multiple income streams are no longer impressive. They're practical. And yet, despite all this pressure, society hasn't collapsed. That's what makes this moment complex. Stock markets still function, major corporations remain profitable, technology continues advancing rapidly. Artificial intelligence integrates into workplaces, increasing productivity but also reshaping job security. Energy production remains strong in key states. Certain metro areas continue to grow. Migration flows toward lower-cost regions persist. There are bright spots, but they are uneven. And uneven growth amplifies frustration. Because when some communities thrive while others tread water, comparison intensifies. Social media accelerates that comparison. People see curated versions of success while privately managing strain. This disconnect widens the emotional gap between perception and reality. The collapse of everyday American life in 2026 isn't universal poverty. It's widespread pressure. It's the normalization of tight budgets. It's the quiet disappearance of financial breathing room. Public infrastructure reflects this slow erosion as well. In some cities, public transit systems struggle with funding shortfalls. Road maintenance gets deferred. School districts face staffing shortages. Emergency rooms operate at high capacity. None of it looks apocalyptic, but it feels stretched. And when systems operate stretched for too long, resilience weakens. The American dream has always been less about luxury and more about momentum. The belief that tomorrow would be better than today. In 2026, many Americans don't expect dramatic improvement. They hope for stability. And that shift from optimism to endurance marks a profound cultural change. The question isn't whether America is collapsing in a cinematic sense. It's whether everyday life is becoming structurally harder to sustain. When housing absorbs too much income, when healthcare feels financially risky, when education requires heavy debt, when basic goods require constant budgeting, the foundation of daily life shifts. And when foundations shift quietly, societies change without realizing it in the moment. The danger isn't explosion. It's normalization. It's waking up one day and realizing that what once felt temporary has become permanent. And for millions in 2026, that realization is beginning to settle in. What makes 2026 different isn't just higher prices or tighter budgets. It's the erosion of predictability. For most of modern American history, there was a rough formula. People trusted. Education led to opportunity. Opportunity led to income growth. Income growth led to asset building. And asset building led to long-term security. That chain now feels fragile. Higher education, once viewed as the clearest path to upward mobility, carries heavier risk. Tuition costs remain high. Student loan balances still weigh on millions. And the return on investment feels less certain in industries being reshaped by automation and artificial intelligence. Young graduates enter a labor market that looks stable on the surface but volatile underneath. Hiring freezes, sudden layoffs, contract roles replacing salaried positions, benefits becoming thinner. Even high-paying sectors are no longer immune to disruption. This creates a new kind of caution. Graduates don't just ask, "What do I want to do?" They ask, what won't disappear? That mindset shifts career choices. It shifts risk tolerance. It shifts innovation itself. Entrepreneurship, once romanticized, now requires navigating higher borrowing costs, uncertain consumer demand, and intense online competition. Starting a small business in 2026 demands more capital, more digital literacy, and more resilience than it did 20 years ago. And yet, people still try, because they feel they have to. When traditional job security weakens, self-employment becomes both opportunity and necessity. But necessity-driven entrepreneurship carries pressure. There's no safety net for slow months. Health insurance remains expensive for independent workers. Retirement contributions often get postponed. So even independence feels precarious. Meanwhile, cost of living differences between states are reshaping migration patterns. Americans continue relocating from high-cost coastal cities to lower-tax, lower-cost regions. But as migration increases, those once affordable regions become more expensive. It's a ripple effect. Affordability moves, but it rarely expands. Remote work once enabled geographic flexibility. Now, with more companies pulling workers back into offices part-time, location decisions grow complicated again. Long commutes return. Housing near business hubs regains premium pricing. The freedom people briefly experienced feels partially reversed. Then there's the cultural layer. In previous decades, consumer culture thrived on confidence. People upgraded phones annually. They leased newer cars every few years. They renovated kitchens, not out of necessity, but aspiration. In 2026, consumption looks more cautious. Cars are kept longer. Repairs are prioritized over replacements. Renovations are scaled back. Subscription services are reviewed and cut. This isn't austerity imposed by government policy. It's household-level restraint. And restraint, when widespread, slows momentum. Economic growth in America has always relied heavily on consumer spending. When households pull back even slightly, the ripple spreads across industries. Retail slows. Hospitality adjusts. Travel becomes seasonal rather than spontaneous. Airlines still fly. Hotels still operate. But average families hesitate before booking. The idea of treat yourself carries a silent footnote. Can we afford it? The mental shift is subtle but powerful. When every decision carries financial calculation, spontaneity fades. That impacts quality of life in ways GDP cannot measure. Relationships feel strain when money conversations become constant. Parents feel guilt when saying no more often. Young adults feel embarrassment moving back home. Older adults feel anxiety watching retirement accounts fluctuate. And beneath all of it sits a deeper concern. If this is stability, what does recession look like? Because here's the unsettling truth. Much of this pressure exists even without a formal economic collapse. Unemployment isn't at Great Depression levels. Banks aren't failing at systemic scale. Supply chains, while strained at times, function. And yet, everyday life feels harder. That disconnect creates cognitive tension. If this isn't crisis, why does it feel so heavy? The answer may lie in cumulative stress. Inflation spikes earlier in the decade raised baseline costs. Interest rate hikes increased borrowing expenses. Asset appreciation benefited those who already owned property or investments, widening wealth gaps. So the system didn't implode. It stratified. Those with assets gained cushioning. Those without assets absorbed rising costs directly. This dynamic reshapes opportunity. Homeowners who locked in low mortgage rates years ago feel anchored and relatively secure. Renters face annual increases. Investors benefit from asset inflation. First-time buyers face higher barriers. Wealth concentration intensifies not through dramatic theft, but through structural math. And structural math is hard to reverse quickly. In 2026, everyday American life hasn't collapsed into chaos. But it has compressed into constraint. People still go to work, kids still go to school, stores remain open, highways remain busy. On the surface, normalcy persists. But beneath that surface, millions feel the narrowing margin between income and expense. The narrowing margin between security and vulnerability. The narrowing margin between hope and hesitation. And when margins narrow for too long, societies don't explode. They plateau. They stagnate. They accept less and call it realistic. That acceptance may be the clearest signal yet. The collapse isn't dramatic. It's the quiet rewriting of what Americans believe is possible. So where does this lead? History shows that America rarely collapses in a single moment. It adjusts, it reinvents, it absorbs shocks, and redistributes pressure across generations. But reinvention requires momentum, and momentum requires belief. In 2026, belief is what feels fragile. Not belief in the country itself, but belief in the equation. The idea that consistent effort leads to measurable progress. That sacrifice today guarantees stability tomorrow. When that equation weakens, behavior changes. You see it in declining birth rates. Starting a family now carries heavier financial risk. Hospital bills, childcare, housing space, education costs, they stack quickly. Couples delay children not out of preference, but out of caution. You see it in retirement trends. More Americans plan to work longer, not because they're passionate about staying in the workforce forever, but because projections no longer feel safe. Healthcare uncertainty alone reshapes retirement timelines. You see it in housing decisions. Multi-generational households increase. Adult children stay home longer. Aging parents move in with their kids. This isn't inherently negative in many cultures. It's normal. But in modern American history, it marks a shift from independence to interdependence driven by economics. And interdependence grows when margins shrink. The broader economy reflects this compression too. Productivity gains from technology, especially artificial intelligence, are real. Companies operate leaner. Automation increases efficiency. But efficiency doesn't automatically translate to widespread prosperity. If productivity growth concentrates gains at the top, pressure at the bottom intensifies. That's the tension of 2026. The United States remains innovative. It remains globally influential. It remains economically massive. But everyday life for the average household feels tighter than the macro numbers suggest. There is also a geographic divide. Some regions thrive due to energy production, manufacturing growth, or tech expansion. Others struggle with population decline, aging infrastructure, or shrinking tax bases. The national story fragments into local realities. One city builds luxury condos, another closes public schools. One suburb expands with new shopping centers. Another sees storefront vacancies multiply. Both exist in the same country at the same time. That unevenness shapes perception. When growth feels selective, trust erodes. People begin to question whether the system is working broadly or only narrowly. And trust, once weakened, is difficult to rebuild. Yet it would be incomplete to call this purely decline. There are signs of adaptation that could form the basis of renewal. Younger generations prioritize financial literacy earlier. Budgeting tools are more sophisticated. Conversations about money are more open than in previous decades. Communities experiment with alternative housing models. Remote entrepreneurship still exists, even if hybrid work has returned. Domestic manufacturing investments expand in certain sectors. Energy independence strengthens in key regions. These are seeds of resilience. But seeds take time, and time feels expensive in 2026. Because the daily experience remains one of calculation. When families plan vacations, they check flight prices repeatedly. When individuals consider career changes, they analyze risk more conservatively. When homeowners consider selling, they weigh interest rate differences carefully. Every major decision now carries financial gravity. And that gravity changes culture. Optimism becomes measured, risk-taking becomes selective, spending becomes intentional. In some ways, This could create a more disciplined economy long term. But discipline born from constraint feels different than discipline born from abundance. The collapse of everyday American life in 2026 isn't about empty shelves or widespread unemployment lines. It's about erosion of ease. It's about how much harder normal life feels compared to a decade ago. When groceries require strategy, when healthcare requires negotiation, when education requires debt modeling, when housing requires dual incomes and still feels tight, the texture of daily life shifts. And when texture shifts long enough, expectations permanently adjust. The real question moving forward isn't whether America can survive this phase. It almost certainly can. The question is whether this phase becomes the new ceiling. If wages sustainably outpace inflation over multiple years, relief will spread. If housing supply meaningfully expands and financing stabilizes, pressure could ease. If productivity gains distribute more evenly, optimism could return. But if cost growth continues to outstrip income growth, if debt continues to substitute for wage expansion, if asset ownership remains the dividing line between security and vulnerability, then the compression deepens. And a compressed society behaves differently. It saves more cautiously. It spends less freely. It trusts more slowly. In 2026, the collapse of everyday American life isn't cinematic. It's statistical, psychological, incremental. It's visible in smaller grocery carts and longer commutes, in postponed milestones and extended side hustles, in careful budgeting apps and late-night financial planning. It's visible in the quiet sentence repeated across households. We just have to be careful. Careful with spending. Careful with risk. Careful with expectations. And when an entire nation becomes careful at once, growth slows, culture shifts, and the American dream transforms. Not into something dead, but into something more fragile. Whether 2026 marks the bottom before renewal or the beginning of a prolonged plateau will depend on policy, innovation, demographics, and global stability. But one thing is already clear. Everyday American life has changed. And millions of households feel it not in headlines, but in habits. Not in panic, but in pressure. Not in collapse overnight, but in the steady realization that maintaining normal life now requires more effort than ever before.